My name is Nate. This is the DivMan channel, and today we're talking about bonds and bond ETFs specifically. Now, if you don't like your portfolio being very roller coastery, even if you're a very boring investor and mainly invest in VOO or SPY or QQQ, and it's relatively safe and boring, your portfolio has probably been a little bit of a roller coaster if you've kept your eye on it the first few days in January. I'm speaking on January 12th, 25. And with bonds, you can hold a bond directly, you get a yield, but you can also do a bond ETF. This is a little bit more liquid. It's easier to buy, it's easier to sell. And so my recommendation, unless you are very sophisticated with your investing, is you should probably hold an ETF instead of a bond directly, unless you really know what you're doing. This allows you to buy and sell these things relatively easily. Now, there has been some kind of rocky stuff going on in the bond world. Here's the Wall Street Journal talking about a bond sell-off, and they're saying maybe you should take the other side. That's because as people sell the bonds, the price of the bond goes down. But what else happens? Those payments of in this case, governments, for those bonds, it stays relatively consistent, so the yield goes up as the price goes down. So let's just go over some bond ETFs. This is a 5-year chart of PIMCO, enhanced short maturity. I'm pretty sure this bond actually uses both a little bit of corporate and government bonds. Its yield is a bit higher than most of the government bond ETFs. But this is a 5-year chart. Looks a little crazy if you just look at it on this scale, but the price movement is not horrible. As you can see, it started out at about $101 per share, and its very worst day in its history appears to be $97 per share. So the sort of volatility you're dealing with these bond ETFs, at least it really depends, but most of them, it seems that the volatility is not as steep as something like VOO or QQQ. Now, on the 1-year chart, though, it's just nice, clean lines. So long as the interest rates don't change enormously, it's going to look like this. Now, why does it look choppy like this? This is the price per share over a year. It's because they're siphoning out the dividend each month. There's probably 12 of these dips here if I counted them. And here's the yield of Mint. It's about 5.22%. SGOV just does government treasuries, 0 to 3 month treasuries. And as you can see, nice clean lines, 5 years. As the interest rates, started to go up back in 2022, and when inflation started to become a problem big enough that the Fed had to deal with it, their yields went up. Here's SGOV. Their yield is about 5%. T-bill, same kind of deal. Their yield is 5%. And this one's an interesting one. This is the BOXX ETF. Now, the BOXX strategy basically involves playing both the upside and the downside in a call on some asset, usually just like the S&P 500 in this case. And the idea is you're just collecting kind of the price arbitrage between the market inefficiencies on the puts versus the calls. But instead of paying the income or the increase from that arbitrage in a dividend, this fund actually just holds it in the NAV, so it's not going to pay a dividend. It's just going to hold it in the NAV, so it has this beautiful, like, straight up line. Obviously, it's just about, I'll just show you the 1 year. So it's 1 year chart, almost 5%. The reason you might want to do this is because there's no taxable event unless you sell a share. And otherwise, you just buy and hold. You can benefit from long-term capital gains by just buying and holding a share of this. Here's a couple back tests I'm doing here. It looks like Mint is basically the winner. If I go back to the oldest of these funds here, I've got SGOV, T-bill, and Mint. And as I was saying, I think it's because I think it's because Mint actually does a little bit of the corporate side, if I remember right. Here's what drip looks like. This is the drip calc. Someone I know from a Discord created this. It's a pretty useful tool for, just pie in the sky, all things being equal sorts of projections. And this says that if you start with 1,000, after a year, all things being equal, you're going to get 2,600 by the end of 2 years. Now, aside from avoiding volatility, not wanting to see your port bleed out during a bear market, why might you want to do a bond ETF in your portfolio? One additional reason is if you are using margin in your portfolio, the volatility can cause you to get something called a margin call. And this means that if the value of the shares that you have purchased go under a certain level, your broker will require you to put additional cash in. Now, if enough of your portfolio is floating in a very non-volatile asset, like something like Mint, as you see here, like even the worst volatility this fund has had back in the height of the pandemic, or what we thought was going to be a horrible pandemic, it really only lost $5 or 5%. That was its worst day, as you can see here. And since, in every normal season, it's relatively stable. So let's see here. This is the big sell-off that happened in the middle of last year. And it really didn't sell off too much, and it regained everything. It regained everything relatively quick by the next month's dividend. So there are as well a little bit more maybe middle of the road yielding bond ETFs. This would be something like here is Spider SPHY portfolio high yield bond. This is going to be below investment grade. This is very high risk stuff. They're lending to companies that either just have some very risky behavior or something. So the yield is going to be a lot higher. This is like lending to someone who went through bankruptcy. They're going to make you pay a much higher interest rate. And so you as an investor can capitalize on that on the corporate level by putting some money in this. And the yield for this one is about 7.8. The downside is you really don't get to, this is more risk on. And so if there is a big drop in the market, this high risk investment of whoever's paying those bonds is at risk, because they have some things that are kind of scary going on. That's why they're paying a higher interest rate. Now, one more possibility that you could benefit from is they're coming out sometime in the next year, it looks like. These are Bitcoin bonds. Bitcoin bonds. Now, a lot of these Bitcoin bonds actually have a 0% interest rate. So these are things like MSTR issuing bonds. And you might wonder, like, what would be the point of buying a bond if I'm only going to get my money back, right? This is because something like MSTR with those bonds is giving bond holders exposure to the price movement of Bitcoin. So while the yield itself is 100, it's just whatever capital you buy the bond for in the original issuance is what they're going to pay back in a dividend. However, the actual price of the bond is going to reflect the price movement of Bitcoin. So this could be some interesting bond investing opportunities, because you'll get a relatively, secure, just little div in your portfolio, and it will somewhat reflect the price movement of Bitcoin in some level. I don't know exactly how that's going to look, but I was looking at one of these MSTR bonds, and the price just goes through the roof pretty frequently. So these are pretty cool ways to use bond ETFs. You're really probably going to get something between 3 and at the best, at the highest risk, like something like 7 to 9% in a high interest rate environment when the Fed is jacking those rates to try to stop inflation. But there are some ways to really try to get a better yield, and these Bitcoin ETFs might have some Bitcoin bond ETFs might have some interesting price movement. So again, just to remind people what the point of this is, it's to keep you from losing your lunch on a bear market, or just a few bear days, a bear week. We might have a really big up year this year, especially with Trump coming in and putting in policies that could help the economy. It could be a really big year, but watching the portfolio that you're holding drop significantly kind of hurts. So bond ETFs can help with kind of that NAV stability. It can help you not get margin called, and it can just be a way to preserve your capital a little bit, so that if you just need to park some money while things are crazy in the market, you can just do that and then pull it back out. And you have a little bit of a yield on that, not a ton, not even really enough to keep up with interest rates most likely, but at least it's something. If this was helpful to you, please like and subscribe. This is just kind of something I myself have been thinking through. I'm not the bond expert, but some of these products are kind of cool, so I wanted to go over them and just show people what's going on with that. Thanks so much for your time. Have a good day.